problem is tech stocks, and it's been a problem since earnings season began. Let's just take a look at the sectors. Energy's holding up all right. Banks are holding up all right, but go a little further down, consumer discretionary a little weak, and look at semis and tech. And there's the problem. And this is not necessarily a new issue here. Let me just show you. And I've chosen April 26th. That was the week when we really got into the heart of earnings season and the big tech names started coming out. And there has been a pretty consistent decline in technology since the earnings came out that is not evident in other sectors. So I'm picked April 26th here, but energy's done all right. Financials have done all right. Industrials have done all right. A little weakness in consumer discretionary because there's some tech-heavy components in there. But look at tech, down 3%. That's pretty consistent. And in fact, it's very consistent across subsectors of technology. Again, I'm picking April 26th as the day when a lot of this started happening when the earnings came out. Put up the next full screen. You'll see right across the board, semiconductors have been weak. Software subsector have been weak. There's Kathy Wood. Arc Innovator down 8%, especially weak. Cybersecurity down 4%. You can go down the list. Apple's down 5%, for example, since April 26th. So again, very consistent decline of about 5% in the overall tech sector since earnings seasons began in earnest. And I think that's the issue now, the valuation question. And this gets to the peak economy, peak earnings, peak everything story, and how much further can you push it? That I think is really the main paradigm that the market's operating under right now. Meantime, over the weekend, we got April data, April trading data, and a lot of good information in here. I am very happy to tell you dividends are back. We had 33 companies announce dividend increases in the month of April. Obviously, they do this in conjunction with their earnings. 0 announced dividend cuts. Remember last year at this time, it was a debacle. People were eliminating deep dividends. They were cutting dividends all over the place. Not a single company cut their dividend or removed it in April this year as opposed to last year. 11 reinstated dividends, including Ross and TJX, Freeport, Estee Lauder, a whole bunch of companies reinstated dividends, and some of them were higher than they were before. Dividends now are estimated to be up close to 5% this year. That's important, folks. People forget about dividends over earnings, but a lot of people care a lot about that, and that's a very important component in helping keep stocks up. Another important component is money that's available to buy stocks. The flows, we got the data for the flows into equities and ETFs in April. They were huge, $258 billion in inflows in equities so far this year. Large inflows into ESG, huge thematic tech ETFs and equity ETFs in general. Last year it was all about bond ETFs. This year it's all about equities. Here's something that's a little contradiction, Carl. April share volumes overall down 30%. Compared to March. I think what's going on here is a lot of people who were retail traders in January and February may have started putting money back into simple old plain vanilla ETFs and equity ETFs. Maybe the Reddit crowd's getting a little tamer these days.
Shepard Smith here. Thanks for watching CNBC on YouTube.